Dear viewers, I am your host Muhammad Asif Jaja and you are watching YouTube channel ETV 786. This channel is created and designed for business students. You are already watching basic concepts of accounting, business law, business taxes, business management on this channel, and now we are presenting business mathematics. Please view, like, share and comment the videos and subscribe the channel to view upcoming lectures. Factors fixing the price of a product. The price of a product is fixed through its internal factors like cost price, profit, margin, trade discount or cash discount, etc. and external factors like competitors' price, consumption factors, demand and supply, etc. The price marked on the commodity is called mark price, list price, catalog price or market retail price. Selling price. For trading purposes, the manufacturer proposes a discount on the market retail price to the buyer. This is called a trade discount. In addition to the trade discount, if the buyer pays cash against goods, he gets another cut called cash discount. The price of the object after subtracting the trade discount and cash discount is called the selling price. Thus, selling price is equal to cost price minus discounts. Profit and loss. A profit is the earned amount received by a business on selling a product, whereas loss is the amount which is less than the actual price of the product. The formula for profit and loss is given based on the selling price and cost price of a commodity. Profit is equal to selling price minus cost price, whereas sale price is greater than the cost price. And loss is equal to cost price minus selling price, where the cost price is greater than sales price. Profit and loss percentage. Profit and loss measures have their percentage value also, and they are given by profit percentage, that is sales price minus cost price divided by cost price multiplied by 100, or we can say that profit divided by cost price whole multiplied by 100. Loss percentage is equal to cost price minus sale price divided by cost price multiplied by 100, or we can say that loss divided by cost price multiplied by 100. Profit and loss tricks. Number 1. When business earn profit and cost price and profit percentage are given, then sale price is equal to 100 plus profit percentage whole divided by 100 and whole multiplied by cost price. When business earn loss and cost price and loss percentage are given, then sale price is equal to 100 minus loss percentage whole divided by 100 and whole multiplied by cost price. When business earn profit and sale price and profit percentage are given, then cost price is equal to 100 divided by whole 100 plus profit percentage whole multiplied by sale price. When business earn loss and sale price and loss percentage are given, then cost price when loss realized is equal to 100 divided by whole 100 minus loss percentage whole multiplied by sale price. Profit and loss tricks. Number 5. For false weight, profit percentage will be profit percentage is equal to true weight minus false weight divided by false weight whole multiplied by 100. Number 6. When there are two successful profits, say m percentage and n percentage, then profit percentage is equal to m plus mn whole divided by 100. Number 7. When the profit is m percentage and loss is n percentage, then profit and loss percentage is equal to m minus n minus mn whole divided by 100. Number 8. If a product is sold at m percentage profit and then again sold at n percentage profit, then the actual cost price of the product will be cost price is equal to 100 multiplied by 100 multiplied by profit divided by 100 plus m into 100 plus n. Number 9. In case of loss, cost price is equal to 100 multiplied by 100 multiplied by p divided by 100 minus m into 100 minus n. Scope of business mathematics. Commercial enterprises use business mathematics to record and manage business operations. They use mathematics in accounting, inventory management, marketing, sales forecasting, and financial analysis. It includes elementary arithmetic, elementary algebra, statistics, and probability. For some management problems, more advanced mathematics such as calculus, matrix, algebra, and linear programming is applied. Simple interest. Generally, simple interest paid or received over a certain period is a fixed percentage of the principal amount that was borrowed or lent. Formula. Simple interest is equal to P multiplied by R multiplied by N, where P is equal to principal amount, R is equal to annual interest rate, and N term of loan in years. Simple interest example. For example, say a student obtain a simple interest loan to pay 1 year of college tuition, which cost $15,000 and the annual interest rate on the loan is 5%. The student repays the loan over 3 years. The amount of simple interest paid will be $15,000 multiplied by 0.05 multiplied by 3 is equal to $2,250. And the total amount payable in 3 years will be $15,000 plus $2,250 is equal to $17,250. Compound interest. Compound interest accrues and is added to the accumulated interest of previous periods. It includes interest on interest, in other words. The formula for compound interest is equal to P multiplied by 1 plus R power T minus P, where P is the principal amount, R is equal to annual interest rate, and T is equal to number of years interest is applied. Compound interest principal. It is calculated by multiplying the principal amount by 1 plus the annual interest rate raised to the number of compound periods and then minus the reduction in the principal for that year. With compound interest, borrowers must pay interest on the interest as well as the principal. Compound interest example. If you need to borrow $500,000 for 3 years from the bank at an interest rate of 5% per year compounded annually with the full loan amount and interest payable after 3 years, what would be the total interest paid? Compound interest is equal to P multiplied by 1 plus R power T minus P. Here the principal amount is $500,000, R is equal to 5% and terms are equal to 3 years. Total interest will be 500,000 multiplied by 1 plus 0.05 power 3 minus 500,000. That will be equal to 500,000 multiplied by 1.157625 minus 500,000, which will be equal to 578,812.5 minus 500,000, which will be equal to $78,812.5. What is an interest rate? The interest rate is the amount a lender charges a borrower and is a percentage of the principal, the amount loaned. The interest rate on a loan is typically noted on an annual basis known as the annual percentage rate or APR. An interest rate can also apply to the amount earned at a bank or credit union from a saving account or certificate of deposit. Annual percentage yield or APY refers to the interest earned on these deposits accounts. Note, higher the risk, higher will be the rate of interest. Borrower's cost of debt. While interest rates represent interest income to the lender, they constitute a cost of debt to the borrower. Companies weigh the cost of borrowing against the cost of equity, such as dividend payments, to determine which source of funding will be the least expensive. Since most companies fund their capital by either taking on debt and or issuing equity, the cost of the capital is evaluated to achieve an optimal capital structure. APR versus APY. Interest rates on consumer loans are typically quoted as the annual percentage rate or APR. This is the rate of return that lenders demand for the ability to borrow their money. For example, the interest rate on credit card is quoted as an APR. The APR does not consider compounded interest for the year. The annual percentage yield or APY is the interest rate that is earned at a bank or credit union from a savings account or CD. This interest rate takes compounding into account. How are interest rates determined? The interest rate charged by the banks is determined by a number of factors, such as the state of the economy. A country's central bank sets the interest rate, which each bank uses to determine the APR range they offer. When the central bank sets interest rates at a higher level, the cost of debt rises. When the cost of debt is high, it discourages people from borrowing and slows consumer demand. Also, interest rates tend to rise with inflation. Properties of high interest rates. To combat inflation, banks may set higher reserve requirements, tight money supply ensues, or there is greater demand for credit. In a higher interest rate economy, people resort to saving their money since they receive more from the saving rate. The stock market suffers since investors would rather take advantage of the higher rate from saving than invest in the stock market with lower returns. Businesses also have limited access to capital funding through debt, which leads to economic contraction. Properties of low interest rates. Economies are often stimulated during periods of low interest rates because borrowers have access to loans at inexpensive rates. Since interest rates on saving are low, businesses and individuals are more likely to spend and purchase riskier investment vehicles such as stocks. This spending fuels the economy and provides an injection to capital market, leading to economic expansion. While governments prefer lower interest rates, they eventually lead to market disequilibrium where demand exceeds supply, causing inflation. When inflation occurs, interest rates increase. Dear viewers, you are watching topics of the business mathematics, some important terms and some important formulas on the topic. For detailed lecture, please keep on watching YouTube channel ETV 786 and don't forget to view, like, share and comment the videos and subscribe the channel to view upcoming lectures. Bye bye till the next show.